Bloomberg Audio Studios. Podcasts, radio, news.
On the calendar this week is what President Trump is calling Liberation Day, Wednesday, April 2nd. That's when the president says we can expect the biggest salvo yet in his widening trade war.
April 2nd is going to be Liberation Day for America. We've been ripped off by every country in the world, friend and foe.
The president raised the stakes this weekend by saying he plans to start his reciprocal tariffs push with all countries. No country spared, at least for now. But we still don't know how high these tariffs will be. There's less uncertainty about the tariff significance, about what they represent. Shawn Donnan covers economic policy for Bloomberg.
Look, I think we're at a point where we are moving towards, and I think this is the key point to remember, one of the biggest acts of American protectionism that we've seen in almost a century, and possibly even bigger than the 1930s Smoot-Hawley tariffs, which have for decades been this kind of emblematic example of a huge protectionist mistake.
The Smoot-Hawley Tariff Act, signed into law by President Herbert Hoover in 1930, not long after the stock market crash. Smoot-Hawley raised duties on all kinds of imported goods brought to the U.S. from all over the world. The government's goal was to protect American producers, mostly farmers, from international competition. Douglas Irwin teaches economics at Dartmouth, and he says Smoot-Hawley led to almost instant reprisals.
Other countries retaliated. They started keeping out U.S. automobiles, U.S. farm goods, U.S. manufacturers by raising tariffs themselves, particularly Canada.
This happened on the eve of the Great Depression, and for decades, the consensus has been Smoot-Hawley was an economic disaster, a mistake. It's been a cautionary tale about the dangers of protectionism. Now, the parallels aren't perfect. The U.S. economy is in better shape today than it was in 1930. But also back then, the U.S. wasn't anywhere near as reliant on global trade as it is today. But Irwin says, President Trump is talking about imposing a tariffs policy that would dwarf Smoot-Hawley.
Well, I think it's really a historic moment. It's a historic turning point in the world economy and certainly U.S. trade policy.
I'm David Gura, and this is The Big Take from Bloomberg News. Today on the show, what President Trump is trying to do with trade policy and what history tells us about what broad-based tariffs could mean. We also have a new Bloomberg analysis of the economic impacts of the tariffs the president says he's planning to put in place. This weekend, President Trump said the rollout of these reciprocal tariffs will affect all countries. There had previously been speculation that the tariffs he said he'll unveil on April 2nd could be more limited. But Bloomberg's Shawn Donnan says a lot is still unknown.
All the details are still being worked out. Even people in the White House don't really know what the exact tariffs are going to be that are rolled out on April 2nd. But what's been very clear, and it's been clear since the campaign last year, it's been clear since January when he started rolling out these different tariffs, is the direction that Donald Trump is going in. And that is that he's erecting a tariff wall around the United States, which is the world's largest economy, and that is going to have consequences for the U.S. economy and for the global economy.
Shawn, he keeps using a term, reciprocal tariffs. What does it mean by definition, and how does he think of that term?
It's a term that he is using to capture all of the perceived barriers that other countries have to U.S. exports around the world, and an effort by this administration to synthesize all of them into a single number, a single tariff, a tariff that is a reciprocal reaction to all of these tariff and other barriers like taxes and regulations and even currency movements that this administration sees to U.S. exports around the world.
Shawn, you've been listening to the president, you've been listening to the Commerce Secretary, the Treasury Secretary. How would you characterize what the overarching goal of these tariffs is?
So there's been different goals that they have laid out for these tariffs. One is to rebalance the global trading system, to try and get rid of the trade deficit and these broader economic imbalances between the U.S. and China, the U.S. and Europe, and somehow restore fairness in their mind to the system. The second one is simply to raise revenues, right? The president has talked a lot about how tariffs raise a lot of revenues for the government and that you can use that to offset income tax cuts, which most economists will tell you is kind of curious because tariffs are a tax on imports that are usually paid by American importers and consumers. The third is to try and get to some kind of deal, possibly, as part of this rebalancing trade, but also to use tariffs as leverage to force people to the negotiating table to try and make concessions to the United States that somehow will help the United States export more and buy less from overseas. The fourth one is bringing manufacturing back to America. And that is really transforming the U.S. economy from one that is consumption-led to one that has a greater role in it for production, as it did in the past, and so on.
We're kind of looking ahead to April 2nd, but there have been a series of these tariff announcements since President Trump was inaugurated back in January, the most recent of which was the 25% tariff on auto imports into the U.S. What was the reaction to those tariffs by other countries, but by investors as well?
So, I mean, those have hit the markets as a big surprise. We have seen stocks in car makers, and we should say that includes U.S. car makers who have most of their production in the United States or in North America, take a big hit as a result of these new 25% tariffs. We've also seen a scramble in Europe to figure out how to respond, a scramble in Japan. We're seeing Canada, where there's now an election campaign going on talking about a fundamental reordering of the economic and security relationship with the United States. And this is just the beginning. We're going to get more of that after April 2nd. We will also get more clarity on some of the other sectoral tariffs, pharmaceuticals, lumber, copper, and so on.
Just ask you lastly before we move on to maybe the economic impact of this. How do all of these policies fit together? Is there kind of a coherent directional sense of what this administration wants to do, not just with April 2nd and the reciprocal tariffs, but with all the policies they've put in place?
So look, I think there's a lot of noise, and sometimes it's hard to detect a coherent message, but I think there's certainly a coherent direction in which they're going, and that is that they want to have these tariffs be a more permanent fixture of the U.S. economy, and that they believe that that's a solution to many of the ills that have affected the U.S., or the perceived ills that have affected the U.S. economy in recent decades.
After the break, what these tariffs could do to the American economy. As Bloomberg's Shawn Donnan says, we likely won't find out until April 2nd how far the Trump administration is planning to go with these reciprocal tariffs. Our colleagues at Bloomberg Economics have tried to replicate the calculations the White House has been doing to model what their impacts could be.
They've kind of come up with a few different scenarios. The maximalist one calls for an increase of the average tariff rate that the U.S. charges on the world up near 40%. And that would take you to the highest level since the 1800s.
Wow.
It would be even bigger than the increase that we saw in 1930 when the Smoot-Hawley tariffs were introduced, the notorious Smoot-Hawley tariffs were introduced. And that would have a huge impact on the U.S. economy. It would take something like, according to Bloomberg Economics calculations, take something like 4% of gross domestic product out of the U.S. economy over 2 to 3 years. That's an enormous impact, even though 4% doesn't sound like much to the average person. It would also lead to higher prices for products and would mean more inflation, which would probably lead to at least persistent higher interest rates. And the worry is that you would have the U.S. economy essentially enter a period of low growth and high inflation, or what we call stagflation.
So that's the maximalist approach. How about the less maximalist approach? Do they have a sense of what that might mean?
Basically, you take it back from there, right? And so if what we get is a 19 or 20% increase in tariff rates, then you're probably only going to take 2% of GDP out of the equation over the next 2 to 3 years. And we have a slightly more minor increase in prices and consumer prices. We should point out that even that would be a bigger impact than the Smoot-Hawley tariffs of 1930. And it would also hit at a time when the U.S. imports just a lot more stuff than it did in 1930. In 1930, imports were something like 5% of GDP. Today, they're around 14% of GDP.
And this is only factoring in the direct effects of these tariffs. It doesn't include any tariffs other countries might levy on the U.S. in retaliation, or the cost of uncertainty caused by these tariffs, how companies might hold off on hiring or big investments that could help them grow.
I was talking to an economist the other day. He said, my frustration is I also can't calculate this even bigger thing, which is what the Trump administration is doing here is ripping apart the global trade rules that have governed the world economy since the Second World War. What happens if the world's last remaining superpower rips up that system that it once led in the building of, and we are just left with a kind of perpetual uncertainty, and all of this whole framework goes away? How do you model the economic impact of that? And the answer from this economist was, I don't know.
Stephen Myron, one of the president's closest economic advisors, was on Bloomberg TV, and he was talking about the impact, as he sees it, these tariffs will have.
U.S. consumers are flexible. We have options. We can produce stuff at home. We have a variety of countries we can import stuff. We can substitute into home production. Whereas countries that sell to the United States are inflexible. They've only got the United States to sell to. There's no alternative. So they're the ones who will bear the burden of this.
What did you make of what he had to say, and how does that sort of reflect or encapsulate the argument the administration more broadly makes?
The argument that the administration makes is that there will be a negligible impact on prices, that all of these fears about slower growth are overdone. There may be a small impact at one point, but that the economy will very quickly digest that and move on. And more importantly, that there's a bigger project afoot here, which is to draw lots of investment back into the U.S. economy, to restore manufacturing, and that in the long run, even if you get a short amount of pain, it will be worth it. One of the things that the administration also latches on to is, this idea of who pays the cost of tariffs. Now, most economists, most businesses will tell you that when it comes to actually handing over the cash for tariffs, it's the importers who pay that, and then they decide whether they're going to pass that on to consumers. And economic study after economic study has shown that a large portion, if not all, of that cost is passed on to consumers. The administration makes an argument that actually the real economic cost of tariffs, and the Stephen Myron in particular makes this argument, Scott Bessent, the Treasury Secretary, has made it as well, is measured in currencies. That, for example, when you put a tariff on goods from China, the Chinese currency will depreciate, the U.S. dollar will appreciate almost the same level of the tariffs, and that as a result, the real cost in terms of reduced purchasing power in the world is borne by the Chinese or the Germans or the Mexicans, who now have a weaker currency that reflects a weaker economy at home. One of the really interesting things we've seen in the last few weeks is that as concerns have grown over the impact on U.S. growth of these tariffs, the dollar has actually weakened, which means that this argument that the administration makes about who bears the actual economic cost is being flipped on its head, even as they continue to make it.
When are we going to see the effects of the tariffs that the administration puts in place? Will it be immediate? Is it going to take a few days, a few weeks? How soon will we know the effect that they're having?
Well, the answer is we're seeing it already. The Federal Reserve in March downgraded its expectations for growth in the U.S. by a big whack, down to 1%, 1.7% growth, I think it is for this year. And that is largely on the back of what has been announced already. But it's also because we are already seeing businesses hit the brakes in terms of investment. So we're already seeing the impact. In terms of the actual numbers, in terms of growth, and so on, it'll probably take a few quarters to work itself into the actual GDP data, into the CPI data. I think we're going to be back in a place like we were during the pandemic, where we're going to be trying to look for a lot more kind of odd, faster return data. Like, do you remember when we were measuring restaurant reservations or traffic through airports or things like that to try and get a sense of what was happening in the economy? And I think In the short term, we're going to be back in that space again, and then eventually it'll all become clear.
So, Shawn, on the one hand, you've got economic historians, mainstream economists saying, take heed of what we learned from Smoot-Hawley. This is going to backfire and have huge deleterious effects on the U.S. and global economy. On the other hand, you have this group within the Trump administration and the president himself saying it's going to be great for the U.S., it's going to bring in a lot of revenue. How long is it going to take to know who's won that fight?
I'm pretty convinced that neither side is going to concede defeat in this fight at any point in the short term or perhaps even in the long term. I mean, there are still people in America today who believe that Smoot-Hawley and the tariffs that were introduced then were a fantastic bit of economic policymaking and who write books making that case. They're in the minority. There are people there are economists who are convinced that the lessons of 2019 were very clear. Manufacturing employment went down in 2019. Industrial production went down in 2019. The economy slowed in 2019 as a result of the tariffs. And they think that tells you that we're going to see the same thing all over again. But, one of the things that happened after Smoot-Hawley was America and the world kind of learned a lesson, a broader lesson. And that's where we get this kind of consensus view and the majority view about tariffs. And you're already starting to see some signs of that. We're seeing Democrats start to make that same argument that this is a tax on the middle class and it's buying power. So the real kind of lesson or the conclusion or the aha moment may not necessarily come in the economic data. It may come at the ballot box, either in the midterm elections or in the next presidential election. Those are likely to become elections in which trade and economic policy become kind of central things. Americans will have to decide whether they want to be an open economy that engages with the outside world, that benefits from imports and travel and the influx of foreign capital and investment in the United States, or in a more closed economy, and one that is growing slower, in which prices are higher, but perhaps the trade-off is that there's a new factory down the road making things that we once imported from other parts of the world.
Shawn, thank you very much.
Thanks so much for having me.
This is The Big Take from Bloomberg News. I'm David Gura. This episode is produced by Alex Ty. It was edited by Tracy Samuelson and Greg White. It was fact-checked by our editorial team and mixed and sound design by Alex Segura. Our senior producer is Naomi Shavin. Our senior editor is Elizabeth Ponso. Our deputy executive producer is Julia Weaver. Our executive producer is Nicole Beamsterboer. Sage Bauman is Bloomberg's head of podcasts. If you like this episode, make sure to subscribe and review The Big Take wherever you listen to podcasts. It helps people find the show. Thanks for listening. We'll be back tomorrow.